Hi, and welcome to this week's market update presentation. Latest news. Geopolitical factors are regaining momentum across energy markets. First, following the phone call between US President Donald Trump and Chinese President Xi Jinping last week, trade delegations from both countries are set to begin trade talks today in London. With trade tensions high between the world's largest economies and tariffs at a significant rate on both countries' imports to each other, market participants are hoping for a positive outcome that will help ease those trade tensions and in turn brighten the global economic outlook. Energy markets have already responded positively to the beginning of those trade talks, particularly oil markets, which have seen an uptick in their price level with brighter optimism regarding the outcome of the negotiations. Elsewhere in the world, Iran rejected the latest US proposal for a nuclear deal between both countries. Given the levels of sanctions on Iran's energy industry, and particularly Iran's oil sector, market participants were hoping that a positive outcome and a deal between both countries would reduce those sanctions and in turn increase global supplies of crude oil in particular. Weather. Moving on to the weather forecast, the latest weather forecasts are indicating above average temperatures across most of Europe over the next 7 to 10 days, particularly across Western and Southern Europe. In terms of precipitation, limited precipitation is forecasted across the next 7 to 10 days for most of the continent, one exception being the Nordic region, where particularly Norway is expected to see more precipitation than is typical for this time of the year. And then lastly, looking at average wind speeds, there we see those come down slightly versus the previous week across the next 7 to 10 days. Crude oil and LPG. Looking at global crude oil prices, we see an uptick in the price level over the past week for both Brent and WTI crude oil prices. For WTI, the front month saw prices increasing by just over 6.4% on the week, while Brent crude oil prices increased by just under 5.9%. Further along the curve, the gains were more modest, with the frontier price increasing around 4.4% for WTI and 4.3% for Brent. The uptick in the market is driven by tighter supply and demand expectations. On the supply side of things, the exit of Chevron from the Venezuelan oil market is reducing global oil supplies by roughly 200,000 barrels per day, while at the same time, wildfires across Canada are reducing Canadian oil production as well. Those two supply shocks are compensating for the increase in oil production from OPEC Plus members, which saw the production quotas increase starting this month. On the demand side of things, as we just mentioned, the optimism surrounding the trade talks between the US and China are increasing future demand expectations for crude oil globally, adding to some additional tightness in the market. Natural gas. In terms of natural gas prices in Europe, prices increased over the past week, particularly in the shorter term. The front quarter, for example, saw an increase of 5.8% week over week, driven by those warmer weather forecasts across Europe, and also some tighter supply and demand balance expectations, particularly given the decrease in Norwegian gas flows over the past week due to the ongoing maintenance there. Further along the curve, the increases were more modest, with the frontier seeing an increase of just 4.7% on the week. The increases in the price level for the frontier, driven less so by the current weather conditions and more by some improved demand expectations due to the brighter economic outlook, due to those trade talks as with crude oil expectations, but also due to some concerns over tighter supply conditions, particularly if price competition for LNG with Asian consumers were to increase. Moving on to the fundamentals and starting with European gas storage levels. Storage levels ended last week at just under 51% full, still below the average since 2012 and notably below last year's level. Nonetheless, the deficit versus the previous year narrowed to just over 20% over the past week, largely due to an increase in the injection rate versus the previous couple of years. Injection rates increased now near some of the highest levels we've seen since at least 2012, and noticeably above the average since 2012. In terms of total supply and demand, while total supply has increased slightly, it still remains near the bottom of the range since 2019. On the other hand, looking at total demand has decreased even to a larger degree, with overall gas demand in Europe at the lowest level since at least 2019. Looking at the European gas supply mix, we note the drop in Norwegian gas flow, certainly compared to where we were just a little over a month ago, primarily driven by the ongoing maintenance across Norway's gas infrastructure. On the other hand, we also see LNG send-outs seeing a slight drop over the past week, in part driven by a reduction in LNG imports into Europe. The drop in LNG imports into Europe due to the drop in overall demand, reducing demand for new arrivals. Looking at global energy export destinations, we do note that US LNG exports continue to primarily be going to Europe, with 68% of all exports from the US going to Europe over the past month. One factor continuing to lead that dynamic is this still limited price competition between Asian and European consumers, particularly given the uptick in the price level over the past week, narrowing the spread between European and Asian prices. Looking at investment fund positions for TTF futures, we see just a slight uptick in net long positions, but not much over the past week. Coal. Looking at global coal prices, we see an uptick across the board, both in Europe and in Asia over the past week for the front year, with the increases a little more pronounced in Europe than in Asia. EU and UK emission allowances. Looking at the emission allowance prices on the European market, we see an uptick in the price level of 4.4% over the past week. While over in the UK market, we saw a slight reduction of around 1.5% week over week. For the European market, the drivers of this upward movement over the past week are certainly the higher demand expectations moving forward. In the immediate term, certainly driven by the higher temperature forecast, leading to expectations of additional power sector consumption in order to meet cooling needs. Then further along the curve, the potential brighter economic outlook leading to some additional demand expectations for carbon allowances in Europe. Over in the UK, price levels continue to find support from expectations of a recoupling between the UK and European markets. In terms of power sector emissions in Europe, those are currently at the lowest level since at least 2019, although we're starting to see a slight uptick in power sector emissions, largely due to the increase in overall power demand due to the warmer temperatures we're beginning to see across Europe. And then in terms of investment fund positions, we see a pretty stable evolution over the past week with not much movement week over week. Electricity. Lastly, looking at electricity markets here, we note the uptick in electricity prices across the board. The increase in electricity prices is very much driven by the increase in natural gas and carbon allowance prices over the past week, which were due to similar price drivers. For the fourth quarter, we saw an increase of just over 6.3%, the warmer weather forecast and increased demand expectations certainly adding to the overall price level. And then for the forward year, the similar drivers that saw an uptick in both the carbon allowance prices and natural gas prices, having a similar impact to electricity prices. When we look at the price evolution across select European markets, we see those having a very similar price evolution across the board. While in the Nordic region, we see slightly more muted increases over the past week, largely driven by the greater precipitation that's being forecasted in the region, easing some of the supply and demand tightness. Moving on to the fundamentals, starting with total demand. Here we see that residual load is now at the lowest level since at least 2019, while total demand did see a slight uptick over the past week, although still near the lowest levels in over 6 years. Looking at the electricity supply mix, here we definitely can note the impact that the lower wind power production so far this year has had on the power mix, with a greater dependence on fossil fuel power generation, particularly natural gas, increasing its share throughout the year, adding support to both gas and power prices in Europe. Looking at nuclear power generation next, here we see that the French nuclear power output remains relatively muted, in line with the average from 2019, with still no significant improvement versus last year. In terms of the renewables and fossil fuels there, we see renewable power generation saw an uptick week over week to a record high for this time of the year, which then helped keep fossil fuel power generation at the bottom of the range from 2019 through 2024. The uptick in renewable power generation primarily driven by an increase in wind power generation over the past week, given the stable evolutions of both hydro and solar power output. Then in terms of fossil fuel power generation, slight uptick in natural gas fossil fuel power generation, largely driven by that uptick in overall demand for electricity. Lastly, looking at the guarantees of origin, there we see a more mixed evolution depending on the production year and technology. In 2026, we're definitely seeing an uptick in both hydro and wind guarantees of origin, likely driven for hydro due to the dry weather forecast that we're seeing for the coming weeks, which is hurting overall hydropower generation across Europe. And the same can be said for wind power output, which has been on the lower end so far this year. Nonetheless, particularly for 2025 year production, we do see a more bearish price evolution across the board. That covers this week's market update. Thank you for joining.